what I love about Portfolio is we always have a theme. We always find the thing that investors are loving and what's coming out to the market. The theme of this magazine is pets. We were looking it up. We have 29 million pets in Australia.
Staggering, isn't it?
We've got 26 million people or something. But I think that's because you, Darren, you're more than your fair share of pets.
I self-confess there. I am a regular customer at Pet Store.
Welcome to the Portfolio Podcast, episode number 4. I am here with Darren and Yosh. Welcome.
Hi.
Hey, good to be back.
Good to see you both.
Exciting.
I am so excited about our final portfolio for the year, Portfolio 173. We'll be auctioning on the 10th, 11th and 12th of December in our usual locations, Opera House on the Tuesday, Crown Casino on the Wednesday and off to the Hilton in Brisbane on the Thursday. This is an incredible portfolio. We are finishing the year with a bang and I am so excited to talk to you about it. We have probably one of the most unique properties coming to market. When I heard about it, I rang all of my clients. I was like, you're not going to believe this. One of the best tenants in the world coming to market. We also have an incredible property everywhere. So looking at the list, we've got property in Tasmania, New South Wales, Queensland. The only state not represented is Northern Territory, and we'd love to sell some great commercial property there. We have, but certainly there's something for everyone. And the benefit of that, obviously, is different tax legislation. Our South Australian properties are generally stamp duty free, which I think is an amazing part of that and changes how investors look at it. And, you know, we've talked previously in episode 3 about the benefits of the softer yields in WA, and we've got some properties in WA too. So, look, without further ado, Yosh, tell me about this, the best tenant in the world, and the first time ever this has been offered an asset like this to private investors. Talk to me about it. You can say the word. Go for it.
No, it is exciting. I think
say it.
We've been talking about it for a while. So we've actually got an investment product that's leased to Amazon.
Wow.
It's I'm super excited about it. I think it's I've had to say to the owner, how did you get them? Because you just never see them.
So where is it? What does it look like? What does an Amazon centre look like?
Yeah, so this is really exciting. It's based in Gosford. Gosford, for people who don't know, is an hour out of Sydney. It's in one of their industrial precincts within that core commercial industrial hub, just off Mans Road. Beautiful facility, like brand new, really like huge height warehouse. The benefit of this is it's a last mile logistics centre for Amazon. Okay?
Explain that to me.
Okay, so it's one of 11 Amazon sites, so last mile logistics. What it means is effectively it's a distribution centre that goes from one of your bigger warehouses into a last mile logistics warehouse, and then basically your delivery trucks leave from that last mile through to the private consumers on delivery basis. But it also means that the consumer can come to site where they can actually pick up their goods and in more of a timely manner. It's a very fluid type asset where you have cars coming in, product is only in there for a short amount of time. As soon as it hits the decks, it's in the cars and they're out.
Yep.
Phenomenal site. It is a beautiful asset. Being on site, you walk it, you just have this vibe about it because you just see the logo and you get excited.
But also, the thing with Amazon is they come into Australia, they go, great, I need space, etc. And most of these are taken up by the big REITs. They do a build-to-rent situation for them and they lock them in for a very long time. So the opportunity for private investors to access this sort of stock, I don't think it's happened before. Do you think it's happened before?
I've never seen it happen. And this is what I was going to say this before, you've hit it on the head. I don't think has been an ability for a private investor to pick out one of the best tenants in the world ever.
Wow.
I'm super excited. And once we sell this, we talk about fast food being rare.
Yep.
Once we sell this, I don't know in my career if I'm going to see another one. I'd love to hope we will, but it's one of those things where, like I said, it's one of 11.
Wow.
It's unbelievable.
And it's absolutely key to the whole process of Amazon because, for Amazon Prime to deliver the next day, I order something on Amazon Prime, it's at my door the next day. I always say, how do you do that? So as I understand it, that's where they're almost like Uber drivers come in, they pick up all of their parcels and they're delivering them. So the location of these sites is incredibly important. And almost Amazon are using all of their digital know-how and ability to position them exactly perfectly. So there's a lot of confidence in that as well, that they've chosen this site. How long's the lease?
7 years to 2030.
Yep.
You get significant depreciation benefits across the lot. It's funny you mentioned location. these tenants are so demanding on the locations they choose.
Yep.
Like incredibly demanding. And so for them to choose this location, this spot, this facility is a huge coup for the asset. But it is well located right in the centre of Gosford. So it is very easy for deliveries to come in and out. It's a short distance between all their major stops that they're actually going to. I think that really bolsters the longevity of that asset as well for that particular tenant coming into their options and into the near future after that.
Yeah.
It's roughly equidistant between Newcastle and Sydney, two of New South Wales' biggest population bases, so it's strategic.
100%. Like that, and that's huge. You know, it is literally. It's a good point Darren makes. It's literally in the centre of those two major hubs, and you can basically go north, south, east, west from there.
Well, I think that's why they've picked it. I mean, these are the smartest tenants in the world as well. They're not just putting a pin on a map. They know exactly where they want to be, down to street, down to location. Absolutely. Darren, I am so excited. I've been talking to you about the portfolio you're bringing to market, which is the whole theme of our magazine. Now, what I love about portfolio is we always have a theme. We always find the thing that investors are loving and what's coming out to the market. The theme of this magazine is pets. We were looking it up. We have 29 million pets in Australia.
Staggering, isn't it?
We've got 26 million people or something. But I think that's because you, Darren, you're more than your fair share of pets.
I have. I shall confess there. I am a regular customer at Petstock.
The industry's worth $14 billion, and it turns over about $33 billion annually. It's a huge employer of people, great tenants. Tell us about this portfolio you're bringing to auction, and is there something for everyone? Where are they located? What's the portfolio all about?
Yeah, there certainly is something for everyone, Ingrid. There's 5 pet stocks within this portfolio, and 4 of those are regional properties across Victoria, New South Wales and Queensland. And then we have another property which is a little bit different because it's a higher price point, but that's in High Street, Paran in Melbourne.
Oh, that's a generational development opportunity, if ever I heard one.
An amazing opportunity, a big site in the middle of High Street. But going back to the regional properties, the rents range from $40,000 to $86,000. So there'll be some opportunities there sub $1 million and certainly sub $2 million.
How long are the leases, though?
15-year leases.
What?
3% annual reviews.
Amazing.
Now, they're 15-year leases to 2037, plus further options.
So wait a second, Darren. You're telling me that I can buy a pet stock for under $1 million with a 15-year lease to a national tenant, and that they're part owned by Woolworths?
Yeah. Now, majority owned by Woolworths, so you don't have to go and buy a $30-40 million supermarket to get a piece of Woolworths. Here, with these properties, you're sub $1 million in some cases, certainly sub $2 million. And then if you're in that higher price point for circa $10 million buyers, Paran is an excellent opportunity. Paran is a 10-year lease. It's a little different, but it's a lease to 2032, so you've still got a long lease. But the interesting one with this one, it ticks all the boxes for an investor. Long lease. Annual reviews, which is hard to believe, of up to 12% a year. That's a year. So your income's going to be growing by a strong clip every year. But you've got, as a landlord, at your discretion to be able to give the tenant 12 months notice. You've got an early termination clause so that if you did want to do something with this site, and this might even apply to owner-occupiers, certainly developers, because it's a commercial one, zoning, which is the premium zoning in Melbourne. You can do multi-storey development, you can do residential, you can do commercial, you can build up, subject of course to council approvals and all the usual approvals. But this is going to appeal to developers, perhaps owner-occupiers and certainly investors, because in its own right, just as an investment, with the lease, the rent reviews,
Underlying land value,
you really cannot go wrong. So it's an exciting opportunity.
And I know a lot of our private families will be looking at that because they'll be looking at it it's a land holding play with income from a great tenant who's going to pay, but it also means that generationally, if you didn't want to develop today or tomorrow, you can really at any time by exercising that option and giving 12 months notice. So you've got time if you did want to make it into a development site. If you want to leave it, for the kids to do that, there's also that option as well. So I think that site offers so much to a different style of investor. But I'm really interested also about the other ones. Where are they located? Because obviously they're the set and forget investments, which most of our investors absolutely love, and especially when Woolworths, owns, is it 55% of the company? Where are they, and what do they have to offer?
Yeah, that's right. So we'll start with cans, Gordonvale cans. That'll be under $1 million. So as you say, where can you buy a Woolworths majority-owned investment tenant for under $1 million? And then we've got Leeton in southern New South Wales. We've got Barham in southern New South Wales, and then Kahuna in northern Victoria. So a real diversity of income, as I say, from about $40,000 to about $86,000. And diversity of location as well. So,
and are they all just pet shops, or have we also got vets located in them? How did the vet piece work?
Yeah, it's actually Mitre 10. So we've got one lease over the entire site to Woolworths.
So one rent payment?
One rent payment, easy to manage whether you're interstate, overseas, whatever. And then you've got, in some cases, Mitre 10 on the site as well. Some of these are quite big sites, 10,500 square metres.
Wow.
Is the largest site. So there's room for Woolworths or /Petstock to be able to accommodate other tenants if they want to. And in some cases they have. There's some quite sizable Mitre 10s on the sites as well. But again, you're only dealing with the majority owned Woolworths Petstock. You've got nothing else to worry about. They're net leases, including land tax, where the legislation allows you to recover land tax. So there's nothing to worry about. Easy to manage from interstate or remotely.
I reckon there's a bit of a theme, I reckon, in this portfolio. Like, I've touched on it a few times, but it is this ability to buy, and this portfolio is a really good example of it, is to buy these covenants at these type of price points. We're talking about Amazon, we're talking about Woolworths Group. It reminds you of similar to when we did, the PFD portfolios and things like that, where we had price points that range from 400,000, up to north of 5 million, 6 million. So it's a really good opportunity, and a rare opportunity that does not come around frequently for investors to have those type of covenants within their portfolio, and traditionally they would have to spend 20, 30, 40 million.
Absolutely. It's one of the most amazing lists we've had this year, I think.
It's going
in terms of diversity of location, as you say, represent in all states.
Price points.
And covenants, some of the strongest covenants.
And we've got something for everyone. Like when I'm looking at the list, we've got, obviously medical, we've got childcare, we've got fast food, large format. Talk to me, Yosh, what about the fast food that's coming to market this auction? You're our fast food expert. I know that we've got the KFC in Queensland, and I think we've also got a KFC in Victoria. But what are you seeing in relation to fast food, and what are the drivers of yield in fast food?
Yeah, so again, one of those asset classes that everyone loves. It's just one of those. It's always historically has always been that way. Portfolio to portfolio, they perform exceptionally well. They are rare items. They rarely come to market. So when people do sell them, we rarely sell them again. Their ownership structure could be in there for a lot of the ones we sell. It could be 30, 40 years, and that's if they come to market. So the ones that do come are highly sought after. As you mentioned, like the assets that we have at the moment are underpinned by the likes of KFC. And in Queensland, that's actually a Collins Food covenant, so an ASX listed covenant. Great location, main road location, highly accessible, beautiful box. It's a really nice asset. We are finding the supply level of fast food continuing to tighten. It's a conduit of the difficulty in developing these sites now. It's cost of construction, cost of land, tenant allocation, discussions on where rents need to be. It is making that supply of new investment product for fast food and other assets in general tighter and tighter. So if you see one on the market, my advice is get one, because it's going to get harder and harder for these assets to be developed and on-sold to investors, and which is just going to increase the rarity for that asset class in years to come.
And that's where your capital appreciation is going to come from, isn't it? Because the next lot that are built, they're going to be higher rents, and that's going to flow into higher pricing.
Yep.
So some of these, I've seen them. I mean, with the cost of the warm shell now hitting $2.5 to $3 million, and then together with the land cost, we're selling them sometimes for less than what it would cost you to replace them.
Oh,
Yeah.
Because the cost of the shell's gone up so much.
100%. It's the discussion that we're having all the time now. It is
Yeah.
exactly that. You know, the cost to build these assets, and the reality is the pricing that's changed for some of these assets over the time that they've been built has just caught up with where we have to be.
And that's driving rents as well, Josh. So you and I were talking about the theme around fast food rents. I mean, you know, I say in my day as if I'm extremely old, but, you know, fast food rents to me were 180 grand net.
Yep.
And you and I were talking about this, and I want to really deep dive on this, is that you're seeing a huge shift in fast food rents and some really new rents coming to market, which are substantially higher because of this build cost. So what are you seeing in relation to rents? Because investors might be sitting there going, what is this? Where's that theme going?
100%. So exactly what you said, the rents are increasing. Fast foods, I think, yeah, if I'm being honest, I think fast food's had a pretty good run of rents. Like, they've been seriously performing really well, you know.
Yep.
And so they...
The wheel will turn again, though. That's
Yeah.
the thing. If you can get in and you know, you're going to ride that next wave, aren't you?
And those businesses have been just absolutely performing. During COVID, I know an operator really well, and I won't say their name because they'll kill me, but I know them really well. And I said to them, we were in COVID, and I said, "Oh, how did you go? It has business and everything." They said, "Well, we traded really well. You know, obviously fast food, because we had the drive-through component. You know, people were getting deliveries, people were using drive-throughs." I said, "So was your turnover okay?" He said, "Oh, mate, if I told you what my turnover was during that, I'd have to kill you." And I said, "Okay, fair enough." But it does. It bolsters that discussion around the security of those businesses. Coming to your point about rents, we are seeing rents climb.
Yeah.
It's a mixture between the obviously locations, land prices, construction prices, as we spoke. The spec of some of these buildings are starting to increase as well. I know I was only speaking to a client recently, and we were talking about the variety of different fast food tenants and their design specs. And I know Hungry Jack's and McDonald's design specs are quite, you know, they're quite heavy on what the new offering, their latest specification design that they're putting into the market. So as an offset on that, because of the cost it takes for a developer to build those type of assets, there is a rent piece that starts to come into those discussions. But I'm seeing deals at $300,000-$400,000 now.
And I think it started, I remember when you sold GYG in Orange about 2.5 years ago, 2 years ago, and what that rent was like 280, 240. And I thought at that time, wow, 240, that can't be.
Yep.
But now it's becoming almost normal place that we're seeing them in the threes, high threes.
Absolutely. And then it went from 240 when we did Narrow, which was 280.
Yep.
And now we're seeing we did Hungry Jack's at 305, then we had a McDonald's at 525. You know, those rents are climbing, and I think they're getting to you're going to see, you know, some larger boxes. You're going to see some new tenants come to the market. You know, there's I'm hearing of Wendy's doing some deals at the moment and looking for really good sites at some higher rents as well. And there are it is going to keep transpiring through to all the users, and they have to, because at the end of the day, the only way to get this product out is to make these products work for developers and landowners. But at the same time, the space is getting competitive.
But for the tenants' growth, they have to keep adding stores.
do.
I mean,
They do.
GYG has, come out saying they're going to open another 200 some stores to underpin their growth and their story to the stock
Phenomenal.
exchange.
They're going to have to pay the rent, aren't they?
And where are they going to find them, Darren?
It's going to be difficult.
And they're going to have to compete with McDonald's,
Yep.
Hungry Jack's and KFC, which
Yep.
which means to me, like, you know, market forces, supply and demand. Surely rents have to continue to go up. So more expensive box. Having said that, they're quite scientific in their approach to that. When McDonald's or Hungry Jack says we need this design, they've done so much research into that to know exactly that is how they're going to flow the most number of customers to sell the most number of burgers at the most, you know, time points during the day. They're not coming at this as a guessing game. So I suppose that investment by the developer or the landlord is for a very, very good reason. It allows them to be able to pay that rent because they know how to maximise the sale price. And even the flow of staff, like in a McDonald's, the flow of staff is very scientific to make sure that the burger comes out as fast as possible, as many as possible.
And their fundamentals have changed over time.
Yes.
You know, obviously, we all know drive-through makes a large portion of that revenue stream. But the likes of having the Uber Eats of the world and
it's changed the industry.
It's just changed the industry because they can. I'm a personal consumer on Uber Eats, and I'd be lying if I hadn't got fast food or a bit of McDonald's or something from Uber Eats.
He doesn't own a dog, Darren.
He makes up for it in other ways.
I might not be lifting pet stock, but Macca's is gone.
But the other thing is, this is happening across childcare, service stations. You were just saying, we look over our shoulder and we look at what a service station sold for 5 years ago, let alone 10 years ago.
Yeah.
And now they're building them for, $4.5 million in some cases.
Yeah.
It wasn't so many years ago you could buy a service station, the land, the whole lot for $4.5 million.
And you've got to remember that transpires then onto depreciation and things
Exactly.
like that. So there is one of those things where some of the sites that we've had, we're talking 70% of the first year's rent and things like that. Like,
which you don't get with equity. You don't get that with shares, do you?
You don't. No, you don't.
Which is another thing.
Well, obviously last night as well, we heard that, Trump is the new president of America and the stock markets went crazy over it. The Australian dollar as a result has weakened. This volatility is something that in my personality, it's very uncomfortable with me. I love my touch and feel property. I know my lease, I know my rent, I know my tenant. The volatility in the share market, the speculation worldwide is just too much. And then you can't leverage it and you can't depreciate it.
100%. And this is what I love about commercial property. It does. Once you buy this asset, irrespective of market forces and what's happening out there, you just collect your same rent and enjoy your increases, the whole ownership structure that you have through that period. Irrespective of what's happening out in the wild world. And I think that's where we've seen a big push from investors who are pulling money out of residential and the share market and things like that to find that certainty and stability in commercial real estate. Notwithstanding the fact that you get to touch and feel an asset, but from an income perspective, that consistent growing annuity stream is just providing people comfort that they don't get from other markets.
And for me, it's a headache thing, right? So if you own a residential property, you're going to get a phone call every second day. There's something wrong with the property. If you own shares, you need to be watching the company, investigating it, tracking it, all the rest of it. I mean, property, you do that initial investigation, you make sure you buy the right thing. And then most of our clients, Darren, would then own it for the next 5 to 20 years, especially your clients.
100%. And even if they do want to sell at any time, they've competed for these assets at auction against multiple, but they're looking at their exit strategies. They're competing against others who are going to buy this asset off them in 5, 10 years, 15 years' time. And I think that gives them confidence as well. That liquidity, even though it's property, you've got an exit strategy. You've competed against other bidders, and they're going to be your future buyers.
Well, our average days of market is 27 days. So if you're looking for liquidity, and then I suppose also it's about having a property that's in demand. So if you're buying a pet stock and you need to bring it back to market, there's going to be a market for it. It's not a complicated asset like an industrial factory with asbestos or things like that. Correct. It's a simple lease. Here it is. Let's come back and sell it if you need that money. So there is that option as well, isn't there?
100%.
Particularly with those lease terms. When you're buying things with 20 and 15 and even 10-year leases, you can hold on to that asset depending on what your lease term is for 5 and 10 years, still sell it with 10 years left or still sell it with 5 years left.
That's right.
You have that flexibility and adaptability to go, okay, well, we've held the asset for the last 10 years, and we do it all the time.
And the rent's gone up, yields have sharpened, interest rates have changed, and all of a sudden...
10-year cash flow if you want, 10-year forward cash flow. Work out where you're going to be in year 10.
100%.
And so with a 15-year lease, Darren, if I was to buy it and I wanted to actually sell it, what is the optimum point in your opinion of divestment? Is it 3 years to go, 7 years to go, 5 years to go? What's that optimum point where you've collected your rent increases and then you look to change it out? Maybe you're looking to upgrade to buy a more expensive property. What would you recommend as being that kind of optimum point?
Yeah, it's a good question. I think it depends on the real estate because quality will always sell. It doesn't matter whether it's a 1 year, 2 year, 5 year lease. I think investors, particularly these days, are smart enough to know good real estate when they see it. But generally speaking, investors and the banks, let's face it, most of our investors, not all of them, some of them do buy with cash, but that's rare. A lot of them are financing these investments, and the banks do like to see some level of certainty, meaning probably 3-5 years at least. So that's probably a rule of thumb. But if it's quality, it doesn't really. It doesn't.
I think,
really
and also
matter.
newer investors who may not have yet established their relationship with the bank, it's their first commercial property. I know the bank really wants 5. But once you have that longer term relationship, and as you say, the underlying aspects of the property are there, then you can get finance on shorter leases. But I would probably say to newer investors who are learning, you'd be wanting probably 5 to go to your bank to start that relationship.
I think you're right, and I think very important for the first purchase, and then once you start to create a bit of diversity, whether that's buying interstate or different asset classes, we always encourage people to perhaps have a childcare, have a fast food, mixed up, get a pet stock. That's important as well, and I think that's important to the financier, that you've got other assets around you that are going to support the one that you're buying at that time. But you're right, as a first purchase, you probably ideally want 5 years. If you're getting more than that, if you're getting 7, 10 or 12 years,
it's great.
Happy days.
Yeah.
And we've helped a number of investors, get exercised options early and things like that. Even only yesterday I spoke to a gentleman I sold childcare to. When he bought it, he had 4 years remaining, and he was questioning me around whether the tenant would stay again for another 5 off their option. Given the location, I was very confident that was going to occur. And yesterday he told me that they exercised 3 years early their 5-year option. So
now he's got 8 years.
He's got 8 years. You know, so it's one of those. Going to your question about real estate, a lot of these, even though he bought it with a more of a shorter tenure, if the fundamentals are there, you've got a confidence level that there's going to be a re-sign.
Yeah, no, that's right. And also, whilst we're emphasising the ease of management with some of these, it is very important to have an advisor or somebody that you can, just bounce things off. They may not be the manager of the property 24/7, but it's important to.
But the good thing was that owner asked the question, because the
Yes.
thing that I see quite regularly because I do a lot of consultancy work and helping a lot of buyers. If they didn't ask the question, the tenant will just sit there and do nothing and go, "Yep, I've got the option. It's not a problem." Helping investors to learn how to ask the question as well, and when to ask the question, because obviously if you ask it the wrong way, the tenant might see opportunity and say, "Oh yeah, with a rent reduction or with this or with that," so it's how you ask them so that you're actually continuing to underpin that value while unlocking the additional value of that longer lease. So I think the right advice from my point of view is absolutely key. And I'm a strong believer in the circle of genius around you. You need your whole toolkit. You need your great property manager. You do need a great agent, and you need your accountant and your lawyer, etc., to make sure that you are absolutely unlocking that value.
Yeah, absolutely. And if you can trigger an option early, it's going to add value to your property. And that might be assisting the tenant with an upgrade on their branding or their fit out, whatever it may be. You might contribute a small amount and unlock another 5-year term 3 years early. You might have 8 years of term.
The big thing we're seeing is obviously the ESG, the environmental factors of the building, where larger tenants are having to meet SOAP 1, SOAP 2 now. They're getting ready to meet them at a higher level in 2025. And so there's opportunities are being unlocked where you can add value to the building, such as solar panels, water tanks, glazing of windows, etc. You can contribute with the tenant, unlock longer leases, unlock their commitment to the site because they're meeting their ESG obligations, and also the bank is looking at those properties more favourably that have met their ESG obligations or are improving their overall ESG rating. And I think a lot of our private investors aren't realising the opportunity there. They're seeing it potentially as a negative. I've got to spend money on the building, etc. But done properly, it's an opportunity to unlock value.
It's a partnership.
Yeah, exactly. So last auction, 172, we set the market in fuel. We changed the whole market. We bought the most number of stock. We bought the best quality. We bought a range of fuel to market. This auction, talk to me, Darren, what fuel have we got coming to market? And what are you looking for your investors in relation to fuel and convenience?
Yeah, we've got 2 exciting opportunities. One of them is an EG at Liverpool in Metropolitan Sydney, and the other one is a Ampol at Thornlea on Pennant Hills Road. 2 excellent locations, big chunks of land. Liverpool is 3,780 square metres.
Wow,
and
what's the land worth there? That's phenomenal.
In one of the highest growth parts of Sydney, stone throw from the new airport, a lot going on, strong population increases. And then you've got Thornlea, just under 3,000 square metres, a short distance out of the CBD on a main road. And both of these properties are surrounded by Woolworths, Dan Murphy's, Bunnings, Harvey Norman, all these tenants within a stone throw from the actual property. So again, we're seeing this resurgence in service stations. Just great real estate fundamentals.
And they're good
what kind of
locations.
price point are we talking there?
Price points on these will be, look, we sold Greenway, and these are metropolitan Sydney, not Canberra, but I tell you what, Canberra's strong, as we know. But these are prime metro Sydney, on rents of $425,000 at Liverpool and $680,000 at Thornlea.
That's feeling a bit cheap to me. So 420,000, 3,000 something square metre site
Yep.
is I mean, that seems to me as an incredible rent. I mean, certainly very affordable for the tenant, so to underlock long-term payment. But it seems like, they seem like cheap rents.
Yeah, no, they're not excessive for Metro Sydney. And as I say, the best leases under the sun again, net leases, everything recoverable, land tax recoverable. Good reviews. So again, it ticks all those boxes. Maintenance, all those things are taken care of by the tenants.
And how long's the lease?
The leases are 15 years for Liverpool to 2031 and a 20-year on Thornlea to 2034.
And are there options after that?
They're not going anywhere you wouldn't think.
Yeah.
Prime strategic positions, high traffic flows, surrounded by national occupants.
And I remember when we sold Camberwell Road in Hawthorn, the 7-Eleven there. I mean, that land site, you're going to get your money from 7-Eleven for the next 20 years, but at the end of that site was one of the most incredible development sites in Melbourne, and it sold for cheaper than house prices.
It's a good point you make, and it's just made me think about the vacant service station at Casula that we sold a couple of auctions ago, the best auction you've ever seen. We had operators, investors, developers, because it was good real estate again.
Yeah.
And you know what it was with that, with that property, we had literally everyone. It was, if it was an operator, it was there. It was a developer, it was there. Everyone was looking at this asset. And it performed really well.
It was one of the best auctions of the year. It must have went for half an hour.
It was strong. It'd be honest.
How many
I don't know,
registered
Cellcare was pretty good last auction.
Cellcare was good. Cellcare was good.
I don't know, Darren.
And that was an exciting property. But
how many registered bidders on that one? There was a lot. Anyway.
There was a lot. And the reality with that one as well is you're getting freehold property as well as it was freehold going concern, right? So there was a business fundamental there as well. But what I like about, when you're talking about Casula and you're talking about Thornlea, you're talking about Liverpool, I know this is the same in most metropolitan cities, but when you're thinking about Sydney, it is so landlocked. It is the underlying land value to buy to buy that land and to get an approval for that type of use today.
That would be hot property.
It is so difficult.
Yeah.
Expense is high, approvals are difficult, accessibility is hard, and particularly on these roads, they're very, very busy thoroughfares.
And actual land size there. Like I would have thought you were going to tell me 1,800 square metres or 1,500 square metres, but you're talking almost an acre.
Well, you could get 2 fast foods on Liverpool.
Exactly.
In fact,
3,700 fast food could fit on as low as 1,400, 14, even lower.
Yeah. So the prospects going forward, we don't think the tenants are going anywhere. They wouldn't be able to replicate these sites.
No.
But the options going forward are immense. There's just so many things you can do with
For me, what
sites.
it talks to is that generational piece because, for me as a parent, I would buy that property, enjoy the rent, absolutely love that property. But it's also something you would keep in your portfolio and you would want to pass down to the kids and the kids' kids. That to me is the epitome of a generational purchase. You wouldn't want to let go of it.
Does that one get paid rent in advance?
No, Greenway did, Canberra.
Greenway.
And that's an important point too. Some of them you do.
Yep.
Rare, but it happens.
Yeah.
Well, we had at Paynesville in last auction, the Australia Post paid their rent 12 months in advance.
It's unbelievable because I've sold a few of those ones for 12 years in advance, and I always say to people, you actually get a chance to double dip because you get some investors that I've sold them to, they get their 12 months in advance and they take all their rent and they put it back on something else.
Yeah.
So they get yield on their real estate and then yield on some, where they put that into the stock market or buy another asset with it, whatever it is. But they get pretty excited the opportunity need to double dip on some of those assets.
So, moving around the ground on the kinds of property that are coming to market, obviously we've got to talk about childcare. Childcare is the absolute darling of the industry. Our investors love it. We sell some, for every 10 childcares that come to market, we sell between 6 and 7 of them. We are the ultimate experts in childcare. Yosh, we're bringing some incredible properties in Queensland to market. Tell me about them.
Yeah, so we've got 2 triple net lease good starts coming. What I really like about these assets is price. They're beautiful price points for private investors. Good long-term leases, like leases to 2040, fixed 3% increases through the whole term. Genuine triple net lease structure.
Talk to me about that. So, if the roof caves in, who pays for it?
Tenant.
If I get a land tax bill, who pays for it?
Tenant.
Okay. If I get a council rates bill?
Tenant.
Tenant, right. The light fittings blow out and fall out of the ceiling?
Tenant.
Right, okay. And this is a lot of people, I get a bit frustrated. As coming from a pre-management background, people calling things triple net leases when they're actually not. So my understanding of a triple net lease is the tenant pays for everything.
Yes.
And so that's something really, really important for people to understand. And they maintain everything too. So in a childcare, you've got kitchens, you've got joinery, you've got front offices. There's actually a lot of equipment in a childcare, and that's all maintained by the tenant.
All maintained by the tenant. And the one we have near Nerang, just west of the Gold Coast, is actually got quarterly market reviews.
What?
So every quarter there's a market review.
How does that work?
So basically every 5 years you get a market review, goes to market, there's a cap on that market review, but you get this lift where you get 3%, 3%, 3%, then you get a jump, and then you get 3%, 3%, 3%.
Okay, so every quarter, every 5 years of the lease. So I thought you were meeting every
3 months.
Every 3 months. I'm like, I think to myself, I don't want to manage that. So what you're saying to me though is that every 5 years. So I mean, obviously, in my experience, childcare rents have gone up. I mean, again, when I entered the industry, when I entered the industry back in, the early 2000s, you had the ABC had gone bust. It was people didn't want it, and you were paying. I mean, I had leases that were managing for $800 a place.
Yes.
Then probably in the early 2020s, we were talking about $2,500 a place. I've seen you guys sell childcares for $5,000 and $6,000 a place.
Yeah,
so
absolutely.
I suppose that 5-year market review becomes absolutely paramount, because otherwise you could miss out on the way that the industry is changing and lifting and the way that rents are moving.
Well, particularly these ones as well, because they're only $1,800 a child. So
wow.
Yeah. So they're below market rent already, and you get to unlock these quarter market reviews every 5 years, and so it's. And from a price point perspective, I love them. Like anywhere between 2.5 and 3.5 million. Yeah. Perfect super fund assets to get childcare assets, let alone just an investment asset with this type of tenant. Good start, largest childcare operator in Australia, 660 sites. They have proven performer. You can actually just set and forget that in super fund and never have to look at it. Yeah. It is one of those assets where often we see people buy these sight unseen. They'll just buy them. They honestly won't look at them until 2041. If anything happens with a tenant sends an email to the owner, says, "Hey, just FYI, we've had a bulb that's broken, or we've had some joinery that's broken. Don't worry, we fixed it." Or can you get someone to fix it? We'll pay for it. There's that. It is such a easily managed set and forget opportunity that ends up just being a one you put in the bottom drawer and just enjoy the annuity stream.
And the other thing I think with childcare, and as a mum of 3 kids, and I went through the whole childcare system, was presentation of the centre was key. I mean, you're not going to walk into a dirty centre, you're not going to walk into a centre that's broken or falling apart. And so the benefit there is that it's actually in the tenant's best interest to maintain the property, 100%. Present the property well, because that's actually core to their earnings and their ability to future-proof their business. So that also talks to the quality of the maintenance that they do.
And their brand awareness is large, because as these businesses continue to grow, whether it's a Good Start or a G8 or or even some of the stronger private operators, in New South Wales we've got Young Academics and Little Zacks. Their brand awareness is a super important factor. So they find it increasingly more important to make sure every centre is at their optimum
Yep.
because
Yep.
it's like they want to make sure that if a parent has a child in, say, Marsden Park, it's exactly the way that it should be in Riverstone. You know,
Yep.
everyone's performing the same way. The parents talk and go, "I've got my child in a Little Zach's Centre or a G8 Centre or whatever it is," and that way it just provides that more brand awareness for these businesses.
And it flows on. It's not just about attracting new customers, is it? It's about attracting new staff, which is, let's face it, is very difficult.
That's the hardest thing in
this
childcare,
market.
Darren.
100%.
So their brand is everything. And they like to take absolute responsibility for that. The presentation, the repairs. The good tenants, they want to do it.
Yeah.
But the
absolutely.
bipartisan support by the government as well. I mean, the government's bringing out all new packages to childcare workers as well. I mean, both sides of government understand the what this contributes to the economy, that if we can have more people working, our productivity increases. And productivity has been a massive component of interest rates, has been a component of the economy that the RBA has been looking at. Michelle Bullock's made a lot of comments about it. So wherever the government can maximise or increase productivity, they're going to do it. And that says to me that long-term, childcare is going to continue to get the investment that it needs, which helps underpin rents, underpins the tenants. And they know that what they're doing is changing the economy.
And also, let's face it, the way that childcare's changed now, like I remember when I was in childcare, it was just, you had your kid in there and I was just barred in with the...
It was some old
It
house.
was just a house that I just sit there
Just
and
don't step on the nail.
But
You certainly didn't have a chef in the kitchen whipping up some sushi or...
this is what I was going to get
Dance
to.
lessons, swimming classes.
100%. And,
Pilates.
And just even the classes that they do and the learners
phenomenal.
they do. If children don't go to these and aren't starting early enough, they end up being behind by the time they're getting to prep and year one and things.
Yeah.
Like it is one of those things where it is now a fundamental piece to that growth journey.
Yep.
And
Well,
so
they're running the kinder programs through a lot of them as well. So, you can choose to send your child to a community kinder, or you can use childcare as your kinder program as well. So they've got the educational piece, and they're formally accredited by the government for that educational piece.
yes.
Yeah.
Absolutely. And it's a hot topic right across the world, isn't it? And as you say, it's not going away.
No.
It's
No.
never going to
No.
go away.
And I think overall Australia is doing it well. And I think these operators like G8 and Good Start, I put a lot of confidence in them. I think they've been around a long time. They do it really, really well. They always pay their rent. I mean, I've never had to have, from a pre-management point of view, never had a conversation with a Good Start or a G8 about their rent. And then, like you say, these market reviews every 5 years, and often people associate a market review with an option exercise. It's not. It's a midterm market. The lease continues. You set the new rent, and then you still get your 3% every year thereafter. So you're still getting that continuity of lease. You're talking about the locations of these, though. Where are they located? Tell me about the location.
Yep. So we've got two. So one's in Beaudesert.
And where's that?
Beaudesert's an hour from the Gold Coast, an hour from Brisbane. Great location, growth precinct. We've sold a number of assets in Beaudesert. It's again ability where low price point, exceptional tenant, triple net lease, expires at 2040, 3% every year. Fantastic asset.
And Nerang, where's that?
So Nerang is basically the Gold Coast.
Okay.
It's 15 minutes from the Gold Coast CBD. Very similar lease structure. What I like about Nerang is it sits on one of their major thoroughfares in Nerang, where we basically have a number of your commercial and retail precincts as well. And this childcare sits on that main thoroughfare. As I mentioned, this asset has quarter market
Every 5
reviews.
years, yeah.
So it is one of those assets where not only do you get the fixed annuity stream that continues for a long tenure to 2040, but you actually have quarter market reviews where you've got these upswings in rent, and because the rent's below market from when you're buying it today, those upswings are going to be quite significant.
And Darren, I'm also seeing, I mean, obviously you've got the pet stocks, which are incredible assets, but I'm also seeing we've got some veterinary clinics. Now, I personally love a veterinary clinic because the stickiness of the fit out. They've often got full surgeries. I've got one in Deniliquin, I've got one in West Wollongong. Tell me about those. I mean, Green Cross Vets as well are a massive tenant. Tell me about those.
Well, we had that great sale in the last auction, didn't we? The Green Cross Vets that sold
It was in Brisbane, wasn't it?
on quite a tight yield.
So why do people love vets? I mean, what is driving that piece, and what's driving the yields on them?
Yeah, again, it's that whole industry, isn't it? 29 million pets in Australia, those big numbers, $14 billion industry, all those things. So that's feeding that sector. We've sold quite a few over the years as well. It's an emerging industry. 15 years ago, we wouldn't have sold many, but we have sold quite a few in the last several years, and it's getting a real following because it is it's an essential need use, and people don't skimp on their pets.
Yeah, they
They
don't.
treated my children, didn't they?
They do. They do.
Well, not you, because you don't have any
I haven't
pets,
got a pet
Josh.
yet, but from what I'm hearing,
We're all a bit concerned about Josh owning a dog.
yeah, no, that'll come in time.
So, and last auction, Darren, we saw a Green Cross vet sell. What was that one?
Yeah, that was Green Cross in Maruka, Queensland, and that sold for 1.7 million, which was 5.1%. So that's pretty strong. Not totally surprising though, because it's a strong asset class with a real following these days.
And we've certainly seen in the last 12 months that the overall yields on vets have compressed some. I think it's 40 basis points. So the demand is absolutely there. What are you thinking? I mean, obviously with West Wollongong, I know the area of Wollongong. Green Cross as a tenant is exceptional. What kind of money am I going to need for that one?
Yeah, with West Wollongong, I think it's fair to say the South Coast has really matured. We're only talking an hour down the road from Sydney, probably only half an hour from Sydney's southern suburbs down at the Shire. So it's not very far out of Sydney. It'd be fair to say that Newcastle, when you compared Newcastle and Wollongong, they're very similar cities, but Newcastle has always been stronger up until now, I think it's fair to say. And the South Coast has got a real focus on it. I think that property is going to do very well, and we expect to have a good following on it just because of, again, the real estate fundamentals, putting aside the use, the real estate fundamentals and proximity to Sydney being only a short trip down the highway.
I think you're right as well on that location piece. Like the South Coast has really seen a real buoyancy with investors. It's only down the road from the portfolio in Warrawong that we sold for 37.7 million.
Yeah, and what were the yields on them?
They ranged between 4 to 5%. You know, and that included, Hungry
Sharper.
Jack's
The McDonald's was sharper than that.
Sub 4%.
No, McDonald's was about 4%, but it was
Because it had the turnover.
turnaround, and
That's
it was one of the largest McDonald's that's ever publicly been sold on market in ever, really. So it was a phenomenal asset, beautiful location, but just a testament to your conversation about the South Coast. That South Coast is seeing a big push from investors, and I think, like you said, it's similar to now the scene is where in Newcastle.
And it reaches further down, doesn't it? Places like Nowra and Ulladulla, they're really hitting their straps
locations
now. So,
Darren, Yosh, thank you so much for your time today on episode 4 of Portfolio. I look forward to talking to you again in February with our we're first to market in February as Burgess Rawson, with the auction on 26, 27, 28 of February. Can't wait to have the roundup of December and find out what happened with Amazon and the pet stocks. But thank you very much.
yeah, exciting times.
No, thanks
Ingrid.
for having us.
Thank you.
Can't wait.